Hi everyone, this is Dr. Shunmugam here from National Institute of Securities Market, and welcome you all to this commodities dialogue. So today in this episode of Commodity Dialogue, I have with me head of research from Nirmal Bang Securities, Mr. Kunal, who is a renowned, speaker in many of the media channels and things like that, and his views are pretty much respected. So in this first session of commodities dialogue, Mr. Kunal is going to take us through the commodity fundamentals, especially in the bullion sector. So let me ask with one fundamental question. So what is that which is driving the bullion prices today? The top 5 factors which are driving the bullion prices today.
Okay, so first of all, thanks NISM for inviting me and giving me this opportunity. And I think the question you are asking in pertaining to the current market scenario or a broader.
The broader scenario
Yeah.
in terms of, like, say for example, if we talk about bullion is a precious metal, and the precious metal, we are drawing that
Okay.
name because they are very precious and they are extracted at
Yeah.
a very high cost, and they are very rare on the
Yeah.
earth and things like that, and people are investing in that because I invest in a particular asset class because I have money to be invested, and that money is losing its value, so I would invest in something where it will gain its value when my paper money is losing. So
Okay.
from that perspective, where do you see the central banks are moving to be in particular,
Okay.
and where do you see the dollar is going to be, so that would it give a strength to the bullion, or would it actually depreciate the bullion from here onwards? So this is going to be for the next quarter, so you can talk about the next quarter.
Okay. So first of all, when you try to analyze gold, okay, it's very complicated. All the traditional factors which determine the outlook of gold, may it be inflation, may it be uncertainty, gold has basically defied all of them. So even during times of uncertainty, gold has gone down for a certain period of time. Even during the times of high inflation, gold has gone down. So this is the best example this year. Ever since the start of the year, the inflation is picking up in US, in Europe, and gold prices are continuously going down. So gold is when you see gold and you say that what are the factors which determines the outlook of gold, it differs from time to time, but all the factors which determines the outlook of gold have defied for a certain period of time. So like I said, at the time of the jewelry demand is robust, gold prices have gone down. At the time the jewelry demand is not there, it's
Where the gold
yeah.
prices went up.
So what are the things, what is something, if you want to sum it up in a very short way, what is something basically which drives the gold demand? So I categorize that thing into two things: love demand and fear demand.
Okay.
So the love demand of gold basically stays in the system irrespective of the prices. So if the prices shoot up quite sharply, the love demand, that is called a jewelry demand, that will go down. Okay. So whenever you see prices shooting about 10%, 20% so last year we saw a 30% jump in the gold prices, and suddenly you see the gold demand was not even 50% of what it used to be, partly because of COVID. So the love demand doesn't is not something which determines the outlook of gold.
Okay.
What determines the outlook of gold is the fear demand.
Okay.
The amount of fear which was there last year. So last year, if you recall it, from the March, this COVID crisis started, and central bankers started to expand their balance sheet the way they have never did. So this kind of monetary experiment which central banks did has been never done in the history of financial market. You take it 100 years, 125 years history, we have never seen this kind of monetary debasement where central banks across the world. So to sum it up, when in 2008 crisis took place, the US balance sheet was 1.5 trillion, or I'm not able to recall, but between 1.5 to $2 trillion.
$2 trillion.
And right now it is almost $8.5 trillion, and by in next 6 months it will be $9 trillion. So in last 2 years, I think the entire markets and entire scenario has changed. So fear demand, the last year's gold's rise is attributed to fear demand.
Fear demand.
So when you determine the outlook of gold, okay, you don't have to worry much about the love demand, the jewelry demand. That is not something but you have to attribute, you have to decide by analyzing how much fear is there in the system. So last year the fear was that in spite of government's effort, central bank's effort, this crisis will not get resolved. The COVID cases will continue to shoot up, people will continue to die, the global economy will fall into deflation. But this year there is a hope that I think the crisis is being controlled. People will be able to live with this COVID crisis. Things are getting normal, slowly and gradually. One after another, economies are opening up. Things are really so. The fear demand has moderated. So if we do not go into how much the ETF bought and how much ETF sold, but the fear demand moderated, hence gold prices are down.
Okay.
Yeah. So now going forward, your question, which,
in the next quarter.
yeah, the main question what you're asking about from the point of view of central banks. So all the futures market basically in today's dynamics are such a unique in nature that they tend to preempt what is going to happen at least 6 months before then the actual event took place. So when in the month of July, US inflation hit 4.5%, 5% at that time, it was very clear that the tapering of the bond purchase program, which is providing, so every year, every month, US is printing $120 billion, 80 and 40, 40 into MBS, 80 into traditional bond. So this 120 billion, this amount is going to get reduced at some point. So from that month, the expectations started to build, and at that time gold was 50,000. Okay, and now gradually even the tapering of bond purchase program by any of the central bankers have not begun, and gold is already at 46,000. So markets are dynamic in the nature. They see that why central banks are going to taper the bond purchase program, because they are expecting things to be normal. Why this kind of measures have been taken by them? Because these are not permanent measures. These are temporary measures. Because of the COVID crisis they printed so much.
They feared economy would.
Yeah. So now since the economies did well in the first half of 2021, we've seen a gradual decline in gold prices. So your next question, which was there, that what do you see for the next quarter from the macro point of view?
Correct.
So what I see from the macro point of view is when the fear moderates, gold will remain under pressure for some time. Okay, but then what will happen is suddenly, if there is a fear, which I will talk in the first. So for example, if something goes wrong in this monetary experiment which is being done, so even if tapering, so if you see what has happened in last from January to July and from August till the end of the December, the growth is basically peaking out. So the best of the growth from the low base, what we should have seen, we saw it. But from now to get that growth, what we saw in the first quarter, it's very difficult. We are not going to see that growth. And when market starts to realize that, when market starts pricing in that, oh, inflation is too much and the liquidity is going to get sucked. So at some point right now, there is a major rally going on in the market right now. Nobody thinks about every day some of the other stocks are going up by 10%, 20%. And so people are not realizing, okay, gold, I mean, it's not interested. I'm going to make 10% in stocks every day rather than investing in gold. So gold has lost its luster to the bull run in the risky assets. So I would not term just equity. The way real estate prices on an average across the world have shot up by 15 to 20%. So the more and more avenues have been created because of the low base in the growth. So last year the growth was so anemic, and suddenly from that in last 7 months we saw robust growth. But now things are heating up. So what happens generally when things heat up, the liquidity will eventually go out of the system, slowly and slowly dry up. That will cool off the inflation and also cool off the growth. So the role of gold will again come. So to be very clear view, gold, I'm not expecting any major crash even if the tapering takes place, because the central banks have printed so much that the problems of the central bank, they cannot basically unwind their balance sheet and go
All
back
of
to 3 trillion or 4 trillion.
all of a sudden,
Yeah, all
it
of a sudden.
cannot happen.
So, gold, I think, is likely to remain under pressure for some time. I see on COMEX, it should not go below $1,700, and in India, it should not go below 44,500. These are the levels where I would start to buy, thinking what is going to happen in next 6 months. So in next 6 months, 3 months to 6 months horizon, the growth is going to slow down. So net ETF outflow, suddenly when they see that they are not going to get great returns out of the other risky assets, they will again start diversifying into gold. If central banks, if for example our central bank wanted to buy gold, and gold was 1900, 200, $2,000, and now it's we are getting at $1,700. More and more central banks wants to have gold as a reserve, as a hedge, because in today's scenario they are not able to invest in other countries' bond. So earlier, more and more, if you look what's happening with the US bond market, you are not getting, Chinese are not buying US bonds, Russia is not buying US bonds, all of them are selling US bonds. So for diversification, for individual, the same way, there is only safer, Bitcoin is still not legal. So the best way central banks can you know uh, shift their risk is through gold. The more, and so India, for example, our FX reserve is growing quite simultaneously, our central banks are buying gold.
Gold as well.
So
Exactly.
that is going to be the case. So I think in next 1 year, 1.5 year, 2 year, more and more central banks are going to buy more and more amount of gold.
To start accumulating
So
physical gold.
some of the loss from the ETF demand is going to be made up by the central bankers. So I'm expecting in next 1.5 year, central bank's demand to be at least more than 20% than what it was.
Okay.
So more and more central banks are going to buy gold once the gold prices goes down.
Okay.
So like I said, I'm not expecting any crash. This is a gradual fall or a correction in a healthier, longer bull market of gold.
Okay.
A central bank doesn't like if gold shoots up to $2,200, $2,400. Central banks are the one who are not going to like it, because they are trying to manage the entire global economy, and if gold shoots up, that sends wrong message to the investors.
Right.
So it's not a market is going to run away immediately, but in this market, if you ask me, gold prices are going to go down to 35,000? No. If you ask me whether they are going to go to 40,000, my answer is no. You are going to see a small bit of correction when the tapering takes place, and when this overall commodity euphoria settles down. And I think that correction would be a good opportunity for the investors to invest in gold for next 2 to 5 years, because this is the time you don't know, we are going to remain into uncharted territory, because we don't know what is going to happen when this stimulus is being scaled back, how the growth will behave, whether there is going to be rate hike, what will happen then, and how these balance sheets are going to be repaired. So Federal Reserve quite bravely did that, but they had to stop it in between and again fall back. So now it's even difficult for them.
Right.
So we are going to see a tax hike in all the economies across developed market. May it be US, may it be Europe, may it be Britain. So this tax hike is going to lead to a cut down in the growth of the corporates, and hence you will see the slowdown in growth gradually. So the best time of growth is over. Now we are going to see some painful time going forward because of the inflation. This inflation is very sticky, and like I said, in spite of the higher inflation, gold prices have gone down. So gold has nothing to do with inflation. The amount of fear has gone down, and that's why gold prices are going down.
So this inflation has already been factored into the
Yes,
gold
it was
prices,
it was
actually.
already factored in last year.
Correct.
So last year gold prices rallied by 35%.
True.
So the amount of balance sheet expansion which took place in last 9 months is greater than what it was last year. So I think the best way I tell our viewers to analyze the gold demand is just to see how much fear is there in the overall financial system. The higher the fear, the higher the outperformance
Of gold.
of gold. And the moment there is a complacency, the way stock market rallied, you see, so stock markets are not the indicator, but it relieves the overall stress in the system. Since the interest rates are low, the debt servicing has become affordable for many corporates. So I was serving debt at 10%, now I'm serving at 6.5%. So overall economies have started to done well. So all the steps which central banks have taken have worked, and that's why gold has corrected.
Okay.
But that doesn't change the long-term trajectory of gold.
Thank you, Kunal, that you rightly said that the central banks are going to taper, and and that fear factor has already been factored into the gold prices and things like that. Actually, so the second issue comes in. People invest in gold, especially. I'm not talking about India, in the international markets. Actually, they have some fear about dollar as well. Actually, whether the dollar will hold its level or it may go down or go up and things like that. Where you see dollar index, and because of that, how the gold prices are going to move. So that's something, if you can explain to us, that will be.
Yeah. So, like I said, these markets anticipates what's going to happen in future. So, ideally speaking, what happened with dollar index is the best example with what happened with gold. So, dollar index from last 3 months is not going down, in spite of the continuous stimulus by the US, and is gradually moving up. So, dollar index have moved from 90 to 94 right now. So, but the markets are anticipating that this bond purchase program is going to get taper, and that's the reason why the dollar index is going up. Fundamentally, the US dollar should have been much lower than where it is right now. So the reason for that is, when you compare dollar, you compare it with the other currencies, and other currencies like euro, pound, Swiss franc, or the Japanese yen. The way US is printing money, no other economies are printing money the way US is printing money right now. So this massive expansion of their monetary base should have ideally led to a crash in dollar. But now what has happened is, not just US, even the Europe is printing, even the Great Britain is printing, even the Japanese are printing. So that's the reason why everyone who have been anticipating the crash in dollar, that is not taking place. So if only US was printing the currency and the other guys were withdrawing their stimulus, then dollar index should have shot up to should have crashed to levels of 85, 86. But that's not happening. Everyone is printing together, everyone is holding back the monetary stimulus, cutting back this monetary stimulus together. So this is the time when I would say dollar index, the likelihood of dollar index going to 95, 96 is a little high for this quarter, rather than going back to 91, 92. That's not going to happen until something happens, where again COVID cases surges in US. That's not happening. Things are getting stable. So by the grace of God, we can say the things are really getting stable on the COVID front. And that's the reason why the dollar should strengthen going forward. And there is, even if there is a bit of correction in the stock markets or in the risky asset class, at that time also dollar will get another boost. So I don't think so dollar index will go below 92 for this quarter, and 95, 95 and a half, or 96 on the max. So even for the US 10-year bond yields, which have made a low, so in spite of, see, the amount of aberration which existed in the system is unbelievable. So in spite of the inflation shooting up, the US bond yield, 10-year bond yield, were going down from 1.5, 1.6 to 1.2. During this time, ideally, because of the higher inflation, the yield should have shot up. But now I think everything is coming. So from 1.2, the US 10-year bond yield stands at 1.5 right now. By end of December, it will be somewhere at 1.8, 1.85. So the view is very simple. We are heading for some more pain in the short term for the bullion, but that short-term pain would provide longer-term opportunity to invest in bullion.
So, dollar is going to, somewhat remain stable or slightly go lower, and so stronger, and so it'll support gold prices to some extent, and it may not crash down or something like that. Actually, so how do you see the emerging currencies, because emerging currencies also, like, so if you look at the physical market for bullion, especially the gold and silver, it's the China and India which is driving the prices. So how do you see the emerging market currencies behaving vis-a-vis dollar, so that will it have an impact on the physical demand for gold or silver, so that their prices will be impacted?
Okay, so for the next quarter, the probability of emerging market currency to appreciate versus dollar is very little, because the dollar index is going to strengthen, number one. Number two, the inflationary expectation are killing the emerging market currency. So we've seen even the Indian rupee, and already most of these emerging market economies, the fiscal deficit is soaring like anything. So we have right now oil at $75. We have right now higher fiscal deficit, and in combination with that, the dollar is strengthening. So it's a perfect storm. So for India, for example, I'm not expecting any major depreciation, but depreciation by 2.5%, something which is on the cards, but nothing to worry
I think to
for.
worry about that.
But if you see the other economies, like if you talk about Indonesia, I think Indonesia currency can weaken quite sharply,
Weaken
because
quite
the growth is very strong in India, and that's not the case. So even if you talk about the Latin American currency, Brazilian currency, or Russian currency, I think they will stand weaker as compared to the US dollar.
And how about yuan?
Yeah, yuan is like a black swan right now. So I'll tell about China. It's very important from the gold market point of view. First of all, we've seen the crisis taking place in the real estate market in the China, and when you say real estate sector in China, that accounts for almost 25 to 30% of their GDP.
Total GDP.
So the likelihood that in order to come out of this crisis, China may have to come up with a debt restructuring for the real estate developers, but for that eventually they will have to depreciate yuan. They will have to gradually weaken the currency in order to relieve their domestic industry.
Okay.
So I think more than the natural fundamentals, Chinese currency, like we all know, I think governments are going to, whenever the right time is there, they will again ease, they will control. So the way they did today morning also, the same way they will continue to, whenever there is a tightness in the credit market, they will infuse via reverse repo or via any other facility, and they will scale back. So I think the likelihood of Chinese currency going depreciating is very high.
Very high. And that will boost the dollar again.
Yes.
Okay, so far we've been talking about gold, which is a major bullion actually. Silver is also plays an important role in the group of bullion metals actually. So where do you see the gold silver ratio is headed towards actually, because that's an important indicator for people in the silver market actually.
Yeah, so for gold silver ratio, last year silver started to outperform the gold.
Correct.
Why? This outperformance was predominantly because of the drop in silver price. So majorly primary producers of silver primary production of silver was coming from Argentina, Peru, Mexico, all the Latin American countries. And in all these Latin American countries, major mines were shut off because of the COVID crisis. So we've seen a major drop. So last year we did our maths, and last year the silver production was down by 9%. The gold production continued to remain static, not even down by 2%, and silver was 9%. So out of the 9% loss in the supply, this year the silver production is up by 4.5%. So that's the reason why silver is not able to outperform gold the way it did last year, and silver prices are remaining under pressure. So I don't expect any outperformance of silver going forward for this year. I don't think so silver will be able to outperform gold. If there is a bull run, I think gold will outperform silver right now, because what has happened, interesting thing which has happened, we have not seen any major sell off in silver ETF, but we've seen a major sell off in gold ETF. So I was just calculating today, more than 245 tons of holdings from global gold ETFs has been shred off. So I think silver ETFs more stable. So whenever there is a bull run, I think people will again rush to buy gold ETF. And then whenever there is a bull run, so I'm not saying it's around the corner, but whenever the prices go up because there is some problem, at that time, I think gold will outperform silver. Silver has a higher beta as compared to the gold, but the production problem seems to be getting solved with a lot of mines are coming back. And now with silver prices, the way they shot up, more and more miners have started their operation. So even next year, I don't see any major supply side shock coming in silver.
In the silver side.
And the scrap supply is very high
Okay.
in silver.
Okay.
So that's the reason why gold will outperform.
Thank you, Kunal, for the wonderful session
My pleasure.
explaining us
My
about the
pleasure.
macro of the bullion sector, actually.